In this video, we're going to look at retail stores Dollar General. And what I do in my videos is I run a discounted cash flow model so I can figure out the intrinsic value of the stock and compare it to the actual stock price to see whether to buy or sell. We also look at the financial ratios of the company and compare them to its competitors. So let's get started with the model. This company has a market cap of $47.6 billion. And we'll just put that in here. And then they have a stock price of $189.07. That's what they're trading at. And we need the free cash flow. So free cash flow is cash flow from operations minus capital expenditures. And the way to value any company is you have to estimate the future free cash flows and then discount those numbers back to today's dollar amounts. And that's what we're doing in the video here. Now I need the net income, and that's on the income statement, and that's the profit and loss for the business. And we also need the revenue, which are the sales. So the numbers look pretty good. They're all fairly consistent and no big negatives. So I think we should get a good value for the company. Let's figure out the capital structure so we know what to discount the future cash flows by. So the interest they pay on their debt is $100 million, and that's on the income statement. And let's go to the balance sheet to figure out how much debt they have. We'll go to the liabilities section, current liabilities, and current debt of $555 million. And then non-current liabilities shows a long-term debt of $2.9 billion. That's debt due after 1 year. They pay 3.45% interest on their debt. Interest is tax deductible, so let's get their effective tax rate. The income before tax is $2.2 billion. That's on the income statement. And the income tax they paid is $489 million. So their effective tax rate is 22%. And the cost of debt is 2.69%. Let's get their cost of equity. So we need the beta. That's the volatility of the stock. And their beta is 0.53, so that's a really low beta. So that means their stock moves roughly half what the market moves. So if the market went up 1% today, this stock should go up 0.5%. Let's get their current assets, and that's on their balance sheet. And current assets mainly consist of cash, accounts receivables, and inventory. And this is what companies use to run their day-to-day operations. So current assets are $5.2 billion. Let's get their current liabilities. These are debts and payables which are due within 12 months. That's $4.5 billion. And their equity, which is also on the balance sheet, that's $6.7 billion. And equity is total assets minus total liabilities. We also need the EBIT for the model. That's earnings before interest and taxes or operating income. And that's $2.3 billion, and that's how much money the company makes on its operational business. So let's look at their weighted average cost of capital. So the cost of debt is 2.69%, and they have 30% debt. And then their cost of equity is 6.39%, and they have 70% equity in that capital structure. So they don't have too much debt, so they're in good shape in that category. So to calculate the WACC, it's a blend of the cost of debt and the cost of equity. And that comes at the 5.27%. And that's what we're going to discount the future cash flows by. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4, and that's $50 billion. We discounted those numbers back to today's dollar amounts. And we get a value of the company of $47 billion. We divide that by 252 million shares, and we get an intrinsic stock price of 186. It's trading at 189, so it's trading at a 1% premium. So it is a sell according to the model, but it's trading really close to intrinsic value. It's usually not this close when I do these videos. Let's look at Simply Wall Street. They're also really close to my number. They're at 188 for their intrinsic value. Let's look at the historical stock price. So the stock has gone nothing but up, it seems like, the past several years. And even during coronavirus, it still has pretty much come up. It dropped a little bit, but not too much. So this looks like a really safe company to invest in, no matter what the times are, because people need to go to stores like this to buy their food and their products. So let's look at their financial ratios to get a little more information. So they have a pretty high PE of 28. That's probably because the stock price has come up so much. and that's price of stock over earnings per share. They have a good price to sales ratio of 1.7. That's price of stock over sales per share. A little bit high in the price to book. Investors are willing to pay $7 for $1 of book value. They have a good current ratio. They can cover their current liabilities. They have a pretty good ROE as well, 26%. That's income over equity. They're doing okay in interest coverage ratio. They can cover their interest payments 23 times. And they're also good in debt, only 30% debt. Best way to look at ratios is to compare to its competitors. So I have Costco and Walmart, and this is the winner for each category and the average for each category. And if it's in orange, that means it's the best of the three. Dollar General is here in the middle. If it's green, the number, that means they're better than the average. If it's red, they're worse than the average. So all three companies have a high PE, probably because the price of the stock has come up so much in recent months. It makes the ratios, especially the PE ratio, look much worse. But they are better than the average, Dollar General. They're worse than the average in price to sales and worse in price to book. But they're all pretty weak in price to book. Walmart is best in those three categories. But Dollar General has the best current ratio, the best ROE, and the best in debt. But they're the smallest company. They're not that small though, $48 billion. It's just they're next to Costco and Walmart, which are really massive companies. So let me know what you think in the comments. Thanks for watching the video.